Good afternoon, everyone. I'm CA Charmi Doshi, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICI. It is my pleasure to be a moderator of this session on GST critical issues in auto sector and overview of forensic accounting and investigation standards. In a short while, we will start webinar. I would like to appraise you about the CPE committee. In today's ever-changing professional scenario worldwide, the biggest challenge professionals face is how to stay on the top of their game while adopting the new requirements and norms. Therefore, it is imperative to aim to be set up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, Continuing Professional Education Committee facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. The program for this evening, we have two sessions: GST auto sector critical issues, overview of forensic accounting and investigation standards. Our eminent speaker, CA Nitesh Jain, is over here. Let me introduce to the faculty. CA Nitesh Jain is a chartered accountant since 2002, and since then he is practicing exclusively in the field of indirect taxes, including GST and customs. He has been speaker at various forums, including ICI branches across Gujarat, CA Association, ICWA Ahmedabad, etc. And he is a member of Indirect Tax Committee of Gujarat Chamber of Commerce of India, GCCI, since last many years. We welcome you, sir, and kindly take the charge of the session.
Thank you. Good afternoon, all. Today's session is on GST on automobile sector. As you know, this sector is one of the largest sectors in India as far as employment and revenue generation is concerned. I'll be sharing my screen with my presentation in a bit. Just a sec. I hope this is visible, Charmi.
Yes, sir.
Yeah. So the session is, as I said, on automobile sector. I'll be taking some critical issues only and not the entire thing because of the paucity of the time. The slides are not going. Charmi can, okay, yeah, sorry. So this is today's agenda. I'll be introducing this sector for you, and then I'll be taking some transactional issues, then some issues relating to ITC on this sector, and then there are some unique sectoral issues that this sector alone faces. So let's start with the introduction. This sector, as I said, is one of the largest by way of GDP contribution. This sector has risen from 2.77% to 7% in the last 3 decades. So in the entire GDP, 7% comes from this sector alone. Employment-wise, about 2 crore people are employed by this sector directly or indirectly, by the manufacturers, by the dealers, by the repairers, the exports, about 41.34 lakh cars or vehicles were sold in 2021, which went to 56 lakhs cars or vehicles, which is a phenomenal growth of 35%. This year, it has tapered down a bit because of the high base in the earlier years. But even though that, considering that, the growth is tremendous. The FDI inflow alone in this sector is $33.77 billion in the last 20-22 years, which is about 5.5% of the total FDI that entire India has in all sectors. Sector size, it is second largest in two-wheelers in the world, sixth largest in passenger vehicles, seventh largest in commercial vehicles, and largest in tractors. So sector-wise also in the world, we are huge. And this is gaining strength every year. Now let's see what are the tax rates internationally. Uh, in Australia, the highest tax bracket is 43% and the lowest is 10% on cars. This is on two-wheelers as well as cars that I'm talking about. England, it's flat 20%. Canada, it is between 10 and 20%. Plus, there is an air conditioning tax. Plus, there is a green tax. So, on an average, the highest tax bracket goes to about 24-25% there. France is same, 20% is the base rate, and then there is a 60 euro per horsepower, and then there is a green tax. Japan has the lowest of all these. It is just 10%, and then there is an environment tax maximum of 3%, which so the highest rate in Japan is 13%. Now let's see what is there in India. As you know, we have a multi-layer rate structure for vehicles. So we start with 5% to 18% for electric vehicles and handicap vehicles. So electric vehicles are 5%, handicap to differently able people can buy a car at 18%. Then there is a 29% rate, then there is a 31% rate, then 43, then 45, then the engine capacity based is 48%, and the highest is 50% for SUVs. So we have rates starting from 5 up to 50. So as you can see, multiple rates, and this is not going to go anywhere soon. The government has already said that compensation cess will continue for foreseeable future. Now let's deal with some transactional issues. I'll be dealing with one issue at a time. First is the sales to SEZ units. We all know that supply of all goods to SEZ units is zero rated under the IGST Act. So the supplier has an option of either paying the tax leviable on the goods, or he can send those goods without charging any tax on it, which is known as zero rated or deemed exports. Now, what needs to be taken care by an automobile dealer while selling cars or two-wheelers to the SEZ units? Yes, they are zero rated, but there are certain conditions which one needs to fulfill. First is you need to file an LUT, a letter of undertaking, on the GST portal. You need to seek the SEZ registration copy from your buyer. Also seek an authorized operation list. Every SEZ unit is given an authorized operation list by the local SEZ officials. So ask for that list. That list should also have a car. Ideally, this condition is not there in the GST law, but these are some safeguards. Seek undertaking that car is bought for SEZ authorized operation. See, there is an amendment that is taken, is being done in the IGST law, whereby authorized operations supplied to SEZ units for authorized operations will only be eligible for the zero rating. But that amendment is already cleared by the Parliament and the state legislative assemblies. But that amendment has yet not been notified. So it is not a part of law as yet. But these conditions I'm just narrating because this will save you from any inquiries and you will be in a better position. And an optional safeguard is ask the customer to get the invoice endorsed by the SEZ custom officer and give a copy of the endorsement to you. The concerned officer will process it on the SEZ portal. So when you sell the car, he will take the invoice from you. He will take the car to the custom gate of the SEZ, get that invoice processed, endorsed by the SEZ customs officer, and he will process that. The officer will process it on the SEZ portal, whereby they will certify that yes, these goods are meant for the SEZ. So it's an additional safeguard. If you do that, it would be better. In case these conditions are not fulfilled, any one of them, and you have an option of charging IGST and cess on the tax invoice. by no means charge CGST and SGST even if the SEZ is near you or in the same state. You will have to charge IGST plus the leviable cess. Now, sales to differently abled person. So, if you're selling a car or supplying a car to a handicapped person, they are given a special benefit under the GST. There is a notification whereby all supplies of cars to them would be at 18% if they fulfill these conditions. Compensation sales would not be leviable. He will get you a certificate from the Deputy Secretary to Government of India from the Heavy Industries Ministry, certifying that car is capable of being used by physically differently abled person. Ensure that the car type and exact model mentioned in this certificate is only supplied, sold. If he comes back to you and says, please give me another variant or another model or a different car, which is mentioned in the certificate, you're not allowed to give him that car at 18%. Additional safeguard is that you need to take an affidavit, or you should take an affidavit from the buyer that he shall not dispose of the car for a period of 5 years after its purchase. A handicapped person or a differently able person is allowed to only one car in 5 years to get this benefit. He cannot buy two cars at 18% simultaneously. Another issue is sales in case of lesser lessee. This issue was a hot topic about 2-3 years ago, but now it is a bit settled. In this case, what happens is a leasing company has a contract with a corporate. Let's say it is ABC Limited. The contract is that ABC Limited will buy cars for its employees and get it leased from this company, from the leasing company. So leasing company's customer would XYZ to whom the car is to be delivered. So XYZ, who is the employee of ABC, will go to a dealer, check out a car, decide that he wants to buy that car. He will notify it to ABC Limited. ABC Limited will go to the leasing company and say, we want to buy this car. Then leasing company will come in contact with that dealer and tell them that please sell this car. So it would be a bill to ship to transaction, whereby buyer will be ABC Limited and consignee will be, leasing company is ABC and the customer is XYZ. So buyer will be the lessor and the consignee will be the lessee. So in your GSTR 1, you will be giving the GST of the leasing company and not the buyer company. The ITC of that car will flow to the leasing company, and leasing company, because it is leasing that car, supplying that car to ABC, to XYZ, then XYZ would be, the ABC would be eligible for that credit. Now, accounting would be sales will be accounted for in the name of the lessor and not in the name of XYZ. As I said, GST return reporting, you will the supply would be to the leasing company. Ownership of the car will remain with lessor because as per Motor Vehicles Act, a person who possesses the car is liable to register that car and not the leasing company. So the car will be registered in the name of the lessee, that is XYZ. Discount given to customer. This is the dealer's customer. So when a car is sold to a customer, there are some pre-sale discounts that are decided. So that discount, as per section 15(3), you can pass it on the face of the invoice itself. So there is no agreement or anything required on this. On the face of the invoice, whatever discount you want to give, you can give it. The question arises is on the post-sale discounts. So many a times for loyalty bonus or exchange bonus, rather exchange bonus, the documentation from the customer goes to the manufacturer. The dealer sends that documentation, and after full verification of those documents, those discounts are given back to the customer. So the car is delivered much prior to the actual discount being given. So the tax invoice is given at a higher value. And when the manufacturer confirms this discount, then only the dealer will pass on that discount. So these are called post-sale discounts. In that case, you need to have an agreement with the buyer pre the tax invoice is generated. So your Z forms that you make, you need to have a clear cut understanding there that such and such discount will be given. The credit note that you issue later after the tax invoice is made must be linked with the earlier invoice. And the ITC, if the buyer is eligible for the ITC and he has availed the ITC on the tax invoice, which would obviously be a higher value, then he has to reverse that ITC based on the credit note that he is receiving of that proportionate amount. So all these three conditions have to be fulfilled. There are certain discounts which are given post sale, but which are without the GST amount. So these are called financial discounts or financial credit notes. They are given by financial credit notes. So here you do not have to reduce your gross liability, and the buyer is not required to reduce his ITC. Then there is an issue of GST on insurance and RTO. Right. Recently, you would have all got a WhatsApp whereby the Andhra Pradesh High Court has just said that there cannot be any RTO tax on the GST portion. So when you go for registration of the car, ideally the dealer will give you an invoice. That invoice is given to the RTO companies, RTOs, and RTO charges 5%, 6%, 12%, whatever is their RTO or municipal tax. And that is on the entire value of the invoice. So Andhra Pradesh High Court said no, the RTO tax or the lifetime tax that the RTOs take should be on the basic value and not on the GST portion. Here I'm talking about GST on insurance and RTO charges, because normally what happens is you sell a car, you also take payments for RTO and insurance on behalf of the customer. So you take the RTO expense, RTO amount, the insurance amount, you get the RTO done for him, as well as the insurance policy also is taken by you on his behalf. So as per GST law, you are not required to add these RTO or insurance charges to the value of the car. So RTO is a payment which you are doing on behalf of the customer. Insurance also you are taking on behalf of the customer. So these payments or these charges are not required to be added. So there will be no GST on these charges by you. Insurance, the insurance company would any which ways be charging their 18% on the insurance policy premium. In RTO itself is a tax. So you don't have to add it to the value and increase the GST portion. Now here there is a misnomer that many people have, that RTO is the responsibility of the dealer. The dealer's responsibility is only that he cannot deliver the car without RTO. But actual responsibility of getting the car registered is of the customer as per the Motor Vehicles Act. The dealer only facilitates this RTO registration through his system, through his people. For this, you may charge him a charge. For example, the RTO tax is 1 lakh. You may charge him 2,000, 5,000 for that service. So those 2,000, 5,000 rupees would be taxable. There is no debate on that. That would be taxable at 18%, not at the car value, because RTO is after the car is invoiced, right? So RTO pay, you don't have to pay any GST on the RTO, and the RTO's facilitation charge or service charge, that would be taxable. GST on booking cancellation. Many times what happens is that a customer comes, he gives you a booking amount, say 25,000 rupees for booking a car, and there is some issue with the car, or he doesn't want to buy that car after when it is about to be delivered, or he wants to change the variant. The dealer in many cases are forfeiting that booking cancellation amount in a few cases. So is there a GST to be paid on this booking cancellation? Now, similar issue arose in the travel industry, wherein you book a ticket or a hotel, and afterwards you cancel, and the agent or the hotel deduct some amount for towards the cancellation. The department has clarified this issue in Circular 178 2022, which was issued in August 2022, wherein in para 11.4 they have said that such charges should be assessed at the same rate as applicable to the service contract. The red part I am just reading. So here they are saying that the airline ticket cancellation charge would be taxable at the same rate as the airline charges are taxable at 5%. So they are not saying here that you should pay 18%, because what they are saying is that this is a additional service in addition to the airline service that you are giving. Hence, it would be taxable at the same rate. Similar is the case with the hotel accommodation. You would be chargeable at 12% of whatever the hotel is charging. In the next 11.5, they have said something completely contradictory. Here they say forfeiture of earnest money is stipulated in such cases not as a consideration for tolerating the breach of contract, but as a compensation for the loss suffered and as a penalty for discouraging the non-serious buyers or bidders. Such payments being merely flow of money are not a consideration for any supply and are not taxable. So in case where you are giving an earnest money to earn the right to tender or bid for a tender, here they are saying that if you forfeit that earnest money, then it would not be taxable because it is merely a flow of money and it is not a consideration for any service. So in 11.4, they are saying it is a service and it would be taxable as the same service under the same head. And in 11.5, they are saying, no, it is not taxable. It is merely a flow of money. So my recommendation would be that you pay 18% on the booking cancellation charges and treat it as a service of tolerating customers' act of cancellation. So this is a midway, because otherwise you on cars, you will be required to pay the car rate if you go by this para 11.4. Moving on, handling and depot charges. In service tax era, many were charging these different kinds of charges. This has come down drastically in the last 3-4 years. Even though many are still charging a similar charge, it may be handling, it may be depot, it may be documentation charge. So what would be the tax rate? As per me, it would be the rate of the rate applicable on to such car, because these charges are all pre-delivery services. So whether you call it documentation for the car, handling the documentation part, handling the depot, you bringing the car from the warehouse, or merely handling the car, polishing the car, or whatever. So any activity which is pre-delivery will be classified in the car itself as a composite supply of goods and services. So it will be taxable at the car rate, whether 29 or 50, whatever is the rate on the car, you'll have to pay that car rate. However, if you can prove that there is a separate service being given to the customer apart from selling the car. Let's say you are charging 5,000 for RTO facilitation. In that case, it would be taxable at 18%, because that RTO is after the car is sold, after the tax invoice is made. So in that case, it would be a separate service post technical delivery of the car. So it would be taxable at 18%. But if it is pre-delivery, taxable at the car rate. There has to be a tangible service being provided post the sale of the car. That is what is the defining line. In many cases, what happens is in March, there are certain incomes like finance or insurance, which the service is provided in March, but the measurement of that service happens in April or May. For some accounting reasons, people or the dealers resort to provisioning of income to match their books. So, under GST law, merely provisioning of income would not be taxable because two events need to take place for an income to become taxable. First is the service has to be supplied. So in this case, the service has been supplied, but the measurement of the service is not happened. The insurance company or the finance company has not approved the working that you have prepared. You have sent them the working, but they have not approved it. So the income that you are thinking, it may change in April or May whenever that approval comes. So this is mere a provisioning of income, and provisioning of income is not akin to supply of service. Measurement has yet not happened of the consideration. Hence, GST will not be payable. You will raise an invoice, a tax invoice for this income in April or May. So that income would be reported in April GSTR 1 and 3B. And hence it will be taxable in April only because the invoice and the measurement are happening in April. Incentives, the original equipment manufacturers or the car manufacturers provide many incentives in various names, in fancy names. So again, as discussed in the earlier part of customer discounts, here also incentives by OEs are in nature of two types. Some of the incentives they are giving under with GST, and some are given as without GST as financial credit notes. So again, the same yardstick will apply that if the post-sale discounts are given under an agreement which was entered prior to the supply happening from the manufacturer to you, the sales bulletin or whatever they keep giving, if that is prior to the supply from the OE to you, in that case, the manufacturer is eligible to give you a GST credit note. And if that condition is not fulfilled of 15.3b, section 15.3b, then he can give you a financial credit note. Your entire books will be same. There would be no financial loss to you. But here there is one issue. If your dealership faces this, please note this, that if you're getting mostly financial credit notes from the OE, then there may be a situation where you are accumulating credits in your books of accounts and not paying taxes by cash on your outward supply because of this accumulation. And this accumulation is basically because the OE is giving you more of financial credit notes and less of GST credit notes. If that is the issue, then you need to discuss with the OE that this cannot go for long, because if you are not paying taxes in cash, then department will start inquiries against you. Then there are certain marketing support. It has decreased a lot since the service tax era. But if there is a marketing support which is coming from the OE to you, then you need to charge 18% on it, because it is a clear-cut service from you to the manufacturer. Additional safeguards, please note, do not show amounts received under financial credit note as an income in the P&L. They must be grouped under purchase head. See, the GST credit notes would definitely go under the purchase head. It will decrease your purchase value in your P&L. But financial credit notes, I've seen people taking them to the other income column in your balance sheet. Please don't do that, because financial credit notes are also essentially discounts. They are not incomes, and you are not paying GST on these financial credit notes. So to avoid unnecessary hassle at the time of assessment and audits by the department, please note that you should book them under the purchase head. The question would arise that the officers will ask for the reconciliation of the purchase value with the GSTR 2A and your ITC. you will need to add back these financial credit notes to your purchase. Then you will arrive at the purchase value, which will match your ITC and the GST to it. But don't, for this sake, for reconciliation sake, book it as an income, because these are not incomes. These are reduction of your purchase values. You are a dealer, you buy that car and keep it in stock. But sometimes the cars are capitalized by the dealers for, say, courtesy car or whatever, for directors. So if a new car lying in stock is capitalized in books, dealer is required to pay an amount equivalent to the amount of ITC availed at the time of its purchase, because you are using this car for your personal use, for director's use, or for courtesy car. Courtesy car is used in workshop, so it will not be eligible for ITC. So ideally, as per GST law, you will have to reverse the ITC on this, because you're not eligible for that ITC. However, in some cases, we've seen that for RTO purposes, a tax invoice is required by the RTO department. So dealers, what they do is they raise an invoice with tax under the self name of the same dealer's name and book it as a B2C transaction. So you charge an outward tax, you pay that outward tax similar to your ITC that you had availed. So it is de facto reversal of ITC. But under GST, supply to self is not taxable. So raising a B2C invoice is legally not correct as far as GST law is concerned. But for RTO purposes, you do that. So basically, you are playing with the same amount unless and until you are making a invoice of the lower value. Then what is the purchase value? You are fine with, because the knocking effect will reverse the ITC. Used car sales by a dealer. You are this is a case where the dealer is a branded cars dealer. Now he's also into used car transactions. So there are two models prevalent in the industry. One is park and sell, where the customer is asked to park his car and the dealer tries to sell it. Once it is sold, dealer deducts his commission and pays the remaining amount to the seller. Here you have to charge 18% on the commission. In some cases, what the dealer does is he buys the car on his own risk. So dealer buys the car from the owner and pays him the decided consideration. Let's say it is 5 lakhs. He incurs certain expenses for refurbishing the same car, say rupees 1 lakh plus GST, and then sells that same car, which has costed him 6 lakhs, at a value of 8 lakhs and makes a profit of 2 lakhs. So now here, as per the GST rules, the valuation would be 8 minus 5. 3 lakhs, he'll have to pay 12% or 18%, whatever type of car it is. And on 3 lakhs, he'll be charging that tax, and he'll be eligible to avail the credit on the 1 lakh expense that he has incurred. So he'll pay a net tax to the government. Now here, the difference between these two is documentation, these two models. So in the first, the risk on the car does not pass to the dealer. In the second, the risk on the car passes to the dealer. So please take care while you make the documentation so that this issue is clear. In the buy and sell, you may also, if you're buying from a registered person and he's charging tax to you, you're also eligible to take the ITC on the car and charge full tax on the 8 lakhs value at the applicable rate. So if, for example, you are buying an SUV where the rate is 50%. So on 5 lakhs, 50% he'll be charged, you'll take that credit, and on 8 lakhs, you'll charge 50% and net off, you'll pay. So the dealer has two options, and this option can be availed vis-a-vis every car. So it is not as if you've opted for the margin scheme, then you'll have to follow that margin scheme in all cars. You can opt an ITC model in one car and a margin scheme in another. Used car sales, if capitalized, many a times what we also do as chartered accountants, we have a car on which we have claimed depreciation because it was capitalized in our books. And we sell that car after 3 years, 4 years, 5 years. So are we required to pay GST on that? Yes, we are. If the sale price of such used car less the income tax depreciated value in books of accounts. So if your sale price is say 5 lakhs and your WDV as per income tax law in your books of accounts is 4 lakhs, then you will, because you are making a profit of 1 lakh, you will have to pay tax on 1 lakh only. Write off, write back. Again, in March, many dealers, what they do is they clear their books. There are many debtors and there are many creditors, which are either written off or written back for various reasons. For example, you bought some goods from a vendor. He raised an invoice of 10 lakhs. You paid him 9 lakhs plus GST. You have withhold the 1 lakh amount because of any breach of contract or bad service, or there is a defect in the goods, and you're not paying him back those 1 lakh and plus GST on that to him. And you, at the end of it, write off this 1 lakh. So, because this will appear as an income in your books, you are not required to pay GST on it because you have not supplied any service or goods to anybody. It is merely an accounting entry whereby you are reducing your expenses. But mind well, if you have taken ITC on 10 lakhs, then you will have to reverse 1 lakh worth of ITC. Paying GST on the income part will not solve the problem. So you will have to reverse the ITC in 3B under the reversal column. Then there are situations where you receive more amounts from your customers. You sold a car, you sold RTO, you sold insurance and many other accessories and finance and whatnot. So, but still, after all, adjusting all these invoices, there is, say, let's say a 20,000 credit balance in the debtor's account. Now you are writing back that account. So that 20,000, if that is against a particular service where the invoice is pending to be made, then make that invoice and pay the applicable GST. But if you can prove that this excess payment received from the customer was merely an excess payment and there was no delivery of service, then this is only a flow of money and no tax would be payable on it. I hope I've covered line access. Huh? Okay. Demo car repair billing. Now you have many demo cars because demonstration cars are required in this industry. Many times these demo cars need repairs in your own workshop. So basically, because this is a service to sell, no invoice is required to be generated unless and until there is an insurance claim. So what you do is raise an invoice in your own name and give 100% discount below it so that transaction is recorded. You will be eligible for the ITC of these spares, whatever you have used, because those spares are used for rendering of your own for service or for supplying of cars. So ITC of spares would be eligible to you. There would be no issue on it. Where insurance claim is raised for, say, a part 80% or 90% of the expense, then you will raise an invoice to the insurance company, charge the applicable tax rate, and you will obviously be eligible for the ITC. For the amount that is not part of the insurance claim, you will raise an invoice in your self name and 100% discount, and you will be eligible for ITC on the entire spares. Sale of truck chassis and body. This issue is faced by the commercial vehicle dealers whereby a customer comes and he asks that I just don't want the chassis. I also want a tipper body or a hydraulic system on it, or say an RMC structure. And he requests the dealer that you please get it done from a job worker. So in this case, the dealer has two choices. He can say, okay, I'll do it for you. And the chassis value and the tipper charge or the job worker charge, he adds in his same invoice, and he raises the entire invoice for the truck as well as the body. And he charges 20, he has to charge 28% on the entire value. You cannot bifurcate the two things as per me. For chassis, you will charge 28, and for the body, it will be 18%, because individually the body is taxable at 18%. But because this is a composite supply of the chassis as well as the body, it will be taxable at the rate which is applicable to the principal supply, which in this case is obviously the chassis. So there are many dealers who are doing otherwise, but there is a specific circular on this very issue. The circular number is at the end 52 of 2018, issued in August of 2018. Specific issue has been covered where they have said it will be the rate applicable to the truck or the chassis. Now I'll take the ITC credit issues. These are some a run through of what are the conditions that you need to fulfill before availing the credit. The expense has to be intended to be used in the course of business. You need to be in possession of an invoice. You have to have received those goods or services. Payment of invoice is done within 180 days. Tax charge has been paid. ITC is visible in your GST activity. So it was just a revision. Now, what happens to the credit of the renovation works? Many a times OEs change the entire design of the showroom, or you yourself go into renovation. If that renovation expense is booked as a revenue expenditure, and you can legally prove that the expense was good enough as a revenue expenditure, then you are eligible for the ITC, and that ITC will not be debated, cannot be debarred. But if that renovation expense is capitalized in your books of accounts, then you're not eligible. Secondly, if the renovation works involves any movable property like furniture or signboard or whatever, in that case, you will be eligible for ITC irrespective of whether you've capitalized it or you've booked it as a revenue expenditure. Demo car ITC. Again, this is a much debated issue in the entire industry. There are many AARs which say that dealer is eligible for ITC, and there are many AARs which are against the dealers. Recently, Goa, earlier the Goa AAR bench had said that ITC is eligible, but recently, in case of a dealer, they have denied this credit. So the party is in the appellate forum right now, but this is a debated issue. As per me, the ITC is eligible on demo cars to a dealer who is into selling of cars. So there is no two ways about it. You don't purchase these demo cars for purposes which a chartered accountant purchases. You purchase these demo cars for as a showcase where the customer comes, he drives that car and then decides which car he's going to buy. So it's a decision-making expense for you, and you are into selling of cars, and hence you are eligible for those. Credit of goods in transit. Now, what happens is in the last week of the month, there are many purchases that happen where you have to match the targets. So you book a new car, new purchases with the manufacturer. They are in transit when the month end comes, and normally they arrive at your godown or showroom in the first week of the next month. So are you eligible for that credit? Because that invoice will be reflecting in your 2B in the month when the invoice is done by the OE. But as I just gave you that circle where you have to receive the goods before availing the credit. So in case of goods in transit, you are eligible for ITC only when you receive the goods. Having said so, if your delivery on risk on those vehicles passes to you from the manufacturer, the factory gate of the manufacturer, then those goods are deemed received by you at the factory gate itself. So you will be eligible to avail those credits if that risk in those goods, the title in those goods has passed at the factory gate on the same day when the vehicle leaves the manufacturer's factory. But if the risk and the title passes to you at your place, at your godown, then in that case, you will have to wait to avail the ITC in the next month. I've already covered this. ITC cases due to 3B and 2A differences. Now, this is an industry issue. You are also facing this. Many of you would have already received notices and fighting this. So recently, the government has issued a circular, a 183, which acknowledges the fact that the law was missing in the relevant years. And hence, they are giving you a different mechanism whereby you can take a certificate from the vendor or a CS certificate from the vendor and then show it to the officer and he'll allow you the credit. But this circular is only for 1718 and 1819. But the law that was missing till December of 21. So what happens for 1920 up to December of 2021? You can take benefit of this circular. Department may or may not agree. But you can take a certificate, keep it with you and reply to the show cause notices with those certificates. Now, what happens to issues or the differences after January 22? Because section 16 was amended on 1st of January 2022. So you don't have a case whereby you can then say, okay, now if it is not reflecting in 2A, but still I have the invoice, I have made the payment, I have a certificate. The government or the courts will not listen to you. So for the period prior to December 21, you please reconcile and take those certificates from all your big vendors and their chartered accountants if the amount is beyond 5 lakhs per vendor per year. But going forward, government and courts will not allow these ITC, which is not reflected in your 2B. So 2B is sacrosanct now. I'll jump to unique issues. Sale of a dealership. There are two models in this. One is the asset sale model, whereby the dealer, the buying dealer purchases some assets and the AMC liabilities. Rest all liabilities and the assets that you are not taking over remains with the old dealer. And in this model, the selling dealer will have to charge applicable GST rates on the asset, less the AMC value, and the transaction would be over. What happens? The other model is the business transfer agreement, whereby the entire business is transferred to the new buyer under a BTA agreement, a business transfer agreement. Now, as per me, a BTA should have following ingredients for it to be called as a BTA or a going tax, because under notification 12/2017 central tax rate, business, if it is transferred as a going concern, then it is not taxable at all. It is completely exempt. For it to be a BTA, these 8 ingredients or 6 ingredients plus the 2 need to be there. First one is the entire business or division in a business is transferred as a whole. He cannot choose that I will not transfer this and I will not transfer that. Entire business or the part of that division as a business has to be transferred. The person buying the business will continue to do the same business. He cannot say tomorrow that I'll discontinue this business. I'm buying this only for the assets and not to do business. Majority of the existing employees get transferred. I agree that they cannot get transferred directly, but there can be an undertaking that I'll take your so and so key employees and so employees into my new company. Existing contracts like lease, etc., also get transferred by way of new lease agreements. Key liabilities which are necessary to run the business also get transferred, like AMC. Unpaid loans which are critical for the new company to run the operations also get transferred. For example, the OE loans, the inventory funding. Seventh is not necessary to transfer old litigation. It is not at all necessary. Not necessary to transfer past outstanding statutory liabilities. But there is a hitch here. There is a section 81 and then there is a section 85 under the GST law, which practically say that if there is past outstanding, the new buyer will have to pay. So please take care whenever you're doing a due diligence to buy out an old dealer, that he doesn't have outstanding liabilities of GST. Income tax and everything, these GST guys are not concerned. But for GST and old litigation, if there is a liability, please take care of it. Then many of you would have been.
Please, sir.
Yeah. Yeah, 10 minutes, right? Okay. Compensation cess on SUV. Many of you would have.
Yeah. Yes, sir. So.
Yeah, Charmi.
Sir, can we start Q&A session?
I'll just finish in 2 minutes.
Okay. Okay.
Okay. Yeah. So, and compensation cess on SUV, many of you would have received the notices. So the issue is with relevance to ARI certificate. If the ARI certificate says that your ground clearance is below 170 mm, the story ends. All these 4 conditions, if they are fulfilled, then only the higher rate of 22% is liable. But if the ground clearance is below 170, then 20% cess is applicable. There are circulars on this, a board circular of excise as well as GST circular. I'll just. Yeah, we can start with questions.
Hello.
Yeah, Charvi.
Yes, sir. In case of reverse charge, and insurance are procured by the supplier on behalf of customers and no separate amount is received. Supplier
No,
is.
Please come again.
In case
Slowly.
of RC, and insurance are procured by the supplier on behalf of customer.
Right.
And no separate amount is received.
No separate amount is received.
Yes, sir.
So I didn't get the question. If the amount is not received, then what is the question?
Sir, further, it is there. Supplier is treating the amount spent as a selling expenses.
So,
whether the above amount should be treated as a discount and reduced for computing GST liability?
No, if you are not taking amounts for RTO or for insurance, you cannot reduce it from your car value. It is towards an insurance that you are giving free. So as I said in my earlier slide, insurance and these are separate services that you provide. So if there is a specific scheme for insurance and everything, then that scheme needs to be seen per se, because I've not seen such schemes whereby the car value is decreased. So I need to see the specific scheme.
Sir, it is asked that GST liability reduced.
On the car, he's asking that the car value can be reduced or not.
Okay.
So I need to see the scheme, but prima facie, I don't think you can reduce the car value.
Okay. Second question is, if a two-wheeler dealer taking service charge from other customer at the time of sale of bike, will it amount to composite supply?
So if you're taking a service charge, as I said, in handling or depot charges or documentation charges, if that there is no tangible service happening other than selling off that two-wheeler, then that amount will be clubbed in the two-wheeler value, and a 28% tax would be applicable.
Okay.
It will be a composite supply.
Okay. And what will be the GST rate? So it will be 28%.
Yes, whatever is the rate on the two-wheeler.
Okay. Third question is notification number 8/2018 is applicable to whom and on which type of motor vehicles?
That was for the used cars.
That is whether all types of vehicles are included, like car, bike, truck, tempos, etc.
No, only there are specific chapter numbers, HSNs given there. Only to those vehicles it will be applicable, not to all.
Okay. Fourth question is GST leviable on payment of interest on delayed payment by customer for purchase of goods?
Yes, as per section 15, if there is any delay payment interest that the supplier is charging, then yes, it would be taxable at the same rate applicable to the goods.
Okay. Sir, fifth question is GST ITC on pre-engineered buildings structures for the auto dealer eligible for ITC even though go down for car storage purpose, car dealer constructed with PEB items?
Yeah, see, this is a dicey question. More of the showrooms and workshops are now prefabricated materials are being used. And as I understand, this entire structure is can be dismantled and used as it is if they want to shift. But it is a dicey question. Entire facts need to be seen. There is no straitjacket answer to this. A prima facie answer is if it is an immovable property that you are creating, ITC is not eligible, but immovable property itself has faced huge litigation under excise and there are Supreme Court judgments which needs to be seen and entire facts need to be seen.
Okay. Sir, sixth question is, can we take the ITC of bills not reflecting in GSTR 2A for the month of March 21st? Since the seller made a mistake, not uploaded the bill in GSTR 1 in March 21. Now the seller given the certificate of DRC 03 payment challans.
Okay, so there are two answers to this. A, I said till December 21, there was no legal mechanism provided under GST law for this matching of ITC. So GSTR 2A got its leg, or 2B got its leg from 1st January 2022. So the first part of the answer is the ITC, if it is not getting reflected in 2A prior to December 2021, you are eligible, you can take the ITC given that you can prove that the vendor has paid the tax. Now coming to the fact that he has given you a DRC3, now if that DRC3 he has paid on his own volition voluntarily, then you can avail that credit, no issues on that. But if he has paid that tax under some investigation by the department of that supplier, in that case, under Section 17, there is a specific debarring provision that any tax paid under Section 73 or 74 is not eligible to be taken as ITC. So that DRC part, you need to take care. You need to take an undertaking from him that it is not paid under any department investigation or scrutiny or whatever.
Okay. Sir, seventh question is, when a used car is sold by applying notification 8/2018, then how to treat the turnover on which GST is not applicable? Acha,
in your 99C, I think he's asking, yes. So it is a non-GST supply. So there is a specific column where you can put this amount as a non-GST supply.
Okay. Is it required to be reported as an exempt turnover in return?
No, it is not exempt. It is a valuation based thing. So it is that amount is not exempt. It is a valuation mechanism which is taxing only the margin. So it is a non-GST value. So put it under a non-GST. If you show it as an exempted value, department will come back and inquire and why this is exempt, and they will open another issues uh, for you.
Okay. Whether GST applicable for sale of second-hand car by a person? If yes, what rate?
Rates I will not be discussing. There are two rates rather, 12%, 18% basis the model, the variant that he is dealing in. Yes, it is taxable if there is a gross margin. I believe this is a question for a chartered accountant, let's say. As I said in my slide, if you are selling a car as a chartered accountant, it will be taxable if there is a gross margin, sale minus WDV as per Income Tax Act. If there is a gross margin, a positive margin, then it would be taxable at 12% or 18%.
Okay. So last question, whether ITC is required to be reversed for goods sent customers under non-returnable gate pass?
I'm not able to understand what he's asking.
Whether ITC is required to be reversed for goods sent to customers under non-returnable gate pass?
What is non-returnable? So if he's selling goods and those goods are not coming back, why would the ITC be challenged? So I'm afraid I'll not be able to answer because the facts are not clear.
Okay. Okay, sir. Q&As are over. Let me give you formal vote of thanks. Thank you very much, sir, for a very kind and insightful deliberation from you on different issues like incentives, GST applicability to disabled person, new car billing, financial credit notes from accounting perspective, ITC credit issues, some of other unique issues. And sir, it gives me immense pleasure that more than 600 participants are currently viewing this webinar. So thank you very much, sir, for coming and giving you insights on this critical issues on auto sector. Thank you very much, sir.
Thank you very much to the Continuing Professional Education Committee for giving this opportunity. Thank you.
Thank you, sir. So let's start with the second session, and our expert speaker is here. Just 1 second. Our second session overview of financial accounting and investigation financial accounting and forensic accounting and investigation standards. Our expert speaker, CA Dr. Durgesh Pandey, is a doctorate in forensic accounting from National Forensic Science University, NFSU, India, and a certified fraud examiner from ACFE, USA. He is a chartered accountant and practicing in the domain of financial crime investigations. He has conducted training for senior IAS officers, IPS officers, enforcement directorate, etc., and international workshops on investigation at Bahrain, Kenya, Sri Lanka, Nepal, and Malaysia. He is also part of expert group for developing forensic accounting and investigation standards syllabus, framing and faculty for flagship course of ICI. With this brief introduction, sir, floor is yours.
Thank you, Charmi. So we are supposed to speak on the forensic accounting and investigation standards. Let me quickly remind the viewers who are listening to us that these standards, as we have and as the opinion of the council, these would be mandatory from 1st of July. So probably after 3 days, these standards will be mandatory for all the investigation. So very quickly, because we have 23 standards, and very quickly we'll be discussing briefly all the standards, how this has been framed, how this will change the landscape of investigation, and how professionals can fall back upon these standards. Of course, we will be getting into the technicalities of these standards, but that we'll be doing very briefly. Okay, let me quickly share the presentation. So I hope the presentation is visible to you. I am audible and the presentation is visible.
Yes, sir.
Okay. Very quickly. So we have forensic accounting and investigation standard. Let me start this by congratulating all of us and lauding the efforts of our council and the Digital Accounting and Assurance Board for coming up with this forensic accounting and investigation standards. Friends, as it is put in popular domain, these are first full set of forensic standards issued by any accounting body across the world. Please understand this. When I'm saying this, I say this with a lot of pride and credibility that these are the first set of standards which have come across the world. We do have, so while doing research, when we started this framing these standards, I am using the word we because I was part of drafting the standards. These standards are still going some minor changes, minor updates, which will be probably notified soon. And these standards, when we started these drafting the standards, we went through the Canadian standards, the Australian standards. We don't call them full set of standards because those are one single standard, couple of standards which give a very high level guidelines. Whereas by way of this document, we have 23 full set of standards which help the professional to navigate this new, exciting and tricky domain of forensic accounting. So these standards very clearly and categorically distinguish themselves from the audit standards, and it is mentioned in multiple times in these standards that an investigation and audit are two different aspects and they cannot be spoken in same breath. Please understand, there is a conscious decision where these standards are not called as forensic audit or anything else. They are specifically called as forensic accounting. That is a conscious decision because of two reasons. First, the accounting discipline or the accounting domain, as it is popularly known as globally, we have the discipline is known as accounting and not auditing. Auditing is a subset of accounting. So we have the nomenclature globally as accounting and not auditing. Ironically, in India, the problem is that with auditing, with accounting comes the concept of bookkeeping. So the moment we say accounting, it is presumed to be bookkeeping, but please understand, auditing is a subset of accounting. That is why we have forensic accounting. Second, we didn't wanted the users or various stakeholders to confuse the services that we render, that is the core audit function that we render, that we didn't want it to be misconstrued from the investigation services. That is why it is deliberately named as forensic accounting and investigation standard. Of course, it is in global consonance, and globally the practice is known as forensic accounting practice, dispute resolution practice, integrity services, so on and so forth. So that is why we have the name forensic accounting. It is explicitly mentioned in the standards that we don't have anything called as forensic audit. Of course, a lot of regulators, a lot of bank, a lot of people are still using the word forensic audit, but please understand that it is a conscious and deliberate effort to stay away from the word forensic audit, and the popular usage of this language should be forensic accounting. Now, as I said, I'll be spending some time in establishing as to what is the utility, because this practice of forensic accounting, it has been emerging since past 5-7 years, and this has become a mainstream practice in past 3-4 years. So, being an early practitioner in this domain, let me explain what is the reason that we have a full set of forensic standards. Before we had these standards, there was no official definition, no white paper, no document, nothing in public domain whereby the terminology of forensic accounting or investigative service or any allied service connected to these practices were defined. So it was like an orphan discipline, and there was nothing in public domain which defines these services. So people like us who earn our bread and butter by practicing in this domain, the problem was that we did not have anything to measure the quality of our service, or we did not have anything to fall back upon what is the minimum prescribed criteria that we should satisfy in order to give a statement that my work sticks to a particular set of standards. It is to fill this gap we have had these full set of standards, whereby these standards establish a benchmark. These standards give a minimum benchmark that if these standards are complied with, the professional has something to fall back. During the course of investigation, during testification, that yes, I have complied to this and this standard. Okay. Again, these standards are very high level standard. Instead of how, these standards are mostly on what. So our standards are very high level standards, and very soon we will be having something called as implementation guides, which will help the professional to implement and to understand, to have a deep understanding of these standards. Now, as I said, we have 23 standards. These 23 standards start with 3 basic overarching documents. These overarching documents have preface, framework, and basic principles. These documents are the crux of the standards, and these are to be remembered while reading all the standards. The basic principles, they have 10 basic principles. 5 of them give the attribute of the professional who's doing the job, and 5 of them give attribute of the engagement that is to be done. Next set of standards, we have the 100 series. The 100 series comprises of 4 standards, whereby it explains certain key concepts which are essential to understand the forensic practice. Next set of series, we have the 200 series. This 200 series are engagement management standards. So in this 200 series, we have 5 standards which start right with the objective of the engagement, acceptance of the engagement. If, and in most of the cases, we do require usage of expert to execute the assignment. In such cases, the work of expert is governed by standard 230. Next, we have engaging with agencies. So during course of investigation, during course of investigative work, in a lot of cases, it is noticed that we have to work with various law enforcement agencies, various quasi-judicial agencies. So how to deal with them, what is required to be told, what documents are required to be maintained, what is the minimum accepted protocol, all these things are informed, all these things are governed by standard 240, that is engaging with the agencies. Next, we have communication with the stakeholders. In 200 series, stakeholder communication is very important. Please understand, most of the practice, most of the work that we do in forensic domain involves dispute. So communication becomes a crux, because last is that we want the forensic engagement itself to be disputed. And mind you, there's always a probability that the forensic engagement, there may come a dispute in the forensic engagement itself. That is why communication is essential, and the protocols related to communication are given in standard 250. Next comes the execution standards. These set of standards, the 6 standards, they give detailed guidance on how to plan, how to document, how to gather and discover the evidence, how to do the work, how to conduct interviews, what review and supervisory mechanism should be adopted, and the most important, testifying before competent authority. It is seen that in a lot of cases, the professional is ought to testify in a court of law. The professional is supposed to defend his report in a court of law. These standard attempts to give a guidance as to how the professional should present in a court of law. Next, we have 400 series. This 400 series, we have specialized standards. So to start with, we have 3 standards in the 400 series, which are applying data analysis. This has all to do with the analysis and the presentation of the data that has been collected during the course of the engagement. Next, we have 420 as evidence discovery in digital domain. These standard governs the system, protocols, and pitfalls of e-discovery. As we understand, computer has become tool and target in most of the financial fraud. So discovering evidence, collecting evidence, and gathering evidence from computer in itself has become a skill and a very big area. This standard attempts to codify those principles based on which the evidence has to be gathered in digital. Next, last specialized standard we have, that is the loans and borrowings. In this standard of loans and borrowing, this standard governs with the loans advanced and the popular diversion and siphoning of fund. A reference is also made to the cases which are covered under the Insolvency and Bankruptcy Act. Very soon, the implementation guides will be coming and they'll be covering guidance on those as well. The last set of standards, set of 2 control. Reporting result, as we know, 510 or 500 series, it will be the report which is to be given to the stakeholder based on investigation and based on review of the procedure in line with the objective of the engagement. The last set of standard is 600 series, that is the quality standard. This is just like we have, I'll say this is just like, I'm not telling this is, but this is like a peer review mechanism, internal peer review mechanism, whereby the firm can continuously evolve and the firm can continuously improve. When I say firm, the professionals firm which is engaged in this can continuously improve upon and build upon the methods in which they're doing the work. So this is the overview of all the 23 standards. Very quickly, let me discuss some of the basic principles which will be used, and let me discuss the framework as to how these standards are structured and how to read them and how to make sense of them. As I said, the overarching documents have 3 set of the overarching documents, that is the 00 series has 3 set of documents, which is the preface, framework, and basic principles. The preface introduces the standard, the need for the standards, and it gives the outline or process as to how the standards are set. The framework, it sets the structure of the forensic accounting and investigation standards. It gives certain basic key terms as to what is forensic accounting, what is investigation, what is litigation support, why there is difference between forensic accounting, and why there is difference between what is the difference between forensic accounting and investigation, and other key terms. Again, all these standards follow a fixed format of 6 sections. What are those 6 sections? We'll be discussing that in the later slides. The basic principles, as we know, The basic principles, as we know, let me come to the basic principles here. The basic principles, as we know, these are 5 basic principles. I said these are the attributes of the professionals. So independence, integrity, due professional care, confidentiality, skill and competence. These are attributes which establish the credibility of the professional. Whereas the other 5 set of basic principles, that is contextualization of situation, primacy of truth, respecting rights and obligation, separating facts from opinion, quality and continuous improvement, these are the attributes which establish the credibility of the engagement. Now, let me explain one of the basic principle which will help you to understand the depth as to what is attempted to explain in the basic principle document. So let us say contextualization of situation, or let us say respecting rights and obligations. So let me explain standard 6, respecting rights and obligation. So our basic principles are very clear that we have to, rather the professional has to give an opportunity to all the parties to be heard. He has to respect everybody's rights and he has to respect everybody's obligation. He cannot take a clouded, I am referring he, but please understand wherever I mean he and she both. I am just for the purpose of simplicity, I am using he. So he or she cannot take sides and cannot start the work with a partisan attitude. Again, audi altrum partem, the principle in the Latin maxim which says opportunity of being heard has to be given to all the parties. Please understand, our standards which were launched in the year 2021, these standards very well incorporated they enshrined the principle of opportunity of being heard. Whereas the Supreme Court, in one of the cases, the Supreme Court has mandated and it has impressed upon the banks that you cannot classify an account as fraudulent before giving ample opportunity to the borrower of being heard. However, we have already included this long back while the standards were developed. Again, we have something called as separating facts from opinion. You would appreciate that the standards that the investigators work, the investigators' role is to separate the facts from the opinion. The investigator or the professional is not supposed to give his opinion. The professional's role is to present the facts. It is for the judiciary or the competent authority, as we have called in the standards. The competent authority is supposed to take a decision rather than the professional giving an opinion. The standards strictly says that a professional is not supposed to give opinion on guilt or innocence of the person. So I, as a professional, if I am undertaking a forensic engagement, I am not supposed to say that so-and-so is either guilty or so-and-so is not guilty. This has been left to the judiciary and no professional can use such language. So please understand, while the report has to be conclusive, the conclusion cannot indict or absolve somebody. Okay. Now, let us come to the 100 series. This is what I was telling. I would, at the cost of repetition, despite me having a short time, let me just remind all of you again. An audit is not the same as forensic accounting or fraud investigation. Hence, forensic audit is a misnomer. It's a misleading term. Audit culminates with expression of independent opinion, whereas forensic work culminates with reporting of evidence discovered. So the mandate is different, the terminology is different, the language is different. Okay. Then, as I said, all our standards have 6 parts. All the standards are bifurcated, are divided into 6 parts. The first part is introduction and scope. So the first part explains the brief background and the scope covered by the standard. It is wherever there is a confusion in the mind of the reader, attempt is made to explicitly state that so and so aspect is not covered by this standard, and it may be covered, it is covered in the other standard. Okay, so the scope is defined very clearly in the introduction and scope para. Next, we have objective. The objective para in any standard is the crux which establishes as to what is the purpose of this standard. Why do we need this standard? What is expected of this standard? That is covered in the objective para. Next, we have requirements. So requirement tries to synchronize the objective with the desired outcome, with the goal as to what needs to be done so that the objective can be culminated into outcome. Okay, so the desired outcome, what is critical to achieve the objective. Wheresoever the requirement para cannot explain the need in detail, there a para called as explanatory comment is included, which explains, which elaborates in detail the requirement or certain key terms. Okay, the next para, the next section that we have, it's a beautiful section which I have not seen in a lot of standards. So this is again a unique feature of our standard, where we have something called as documentation of work procedure. Now this para, it gives an indicative list. This para gives an indicative list that if you want to demonstrate conformance to a particular standard, this para gives the list of documents which, if maintained, will give a confirmation that the requirement of these standards have been complied with. I hope it is what I'm telling is making sense. This para gives the list of the document which is to be maintained by the professional. If such list of document, or if such procedure, or if such documents are maintained, they in a way assure the professional, and the professional can demonstrate that he has followed these set of standards. Okay, the last para 6th is effective date, and this simply means as to what date the standards will be effective from. Okay, now let us come to the first set of standards, which is the 100 series. I have 30 minutes, of which I understand I'll be speaking for 20 minutes, and we'll be having question and answer for 10 minutes. So in 20 minutes, I would like to cover the 20 standards, which will very basically, so I don't think I'll be running slide by slide. I'll be explaining the highlights of each of the series and each of the standard. So the first standard that we have, 110, where we have nature of engagement. Now in this standard tries to explain as to a forensic engagement. Please understand, we use the word engagement and assignment in the standards. The word engagement refers to the complete engagement that the professional is appointed on, whereas the word assignment refers to those, or probably a part of engagement which the professional is working on. So engagement is the bigger circle, and assignment may be a part of the engagement. So one engagement can have several assignments. This is the language which is used in the standards. Okay, so we have 3 broad type of engagements as covered by the standard. The first is forensic accounting. Forensic accounting engagement refers to, and then we have a detailed explanation as well. That is also there in 200 series, in standard 210, where we have an annexure. So it explains that forensic accounting refers to any accounting, legal, or regulatory, including contractual breaches, to explain the fact and discovery of evidences with usage of accounting skills. So wherever you have strong accounting skills, accounting knowledge to be used, there we call it forensic accounting. Whereas where we are investigating into the operational issues, there we cover it as investigation services. So a typical example can be financial statement manipulation, asset tracing, fund diversion, anti-money laundering. These are forensic accounting services. Whereas fraud investigation, that is cyber fraud, insurance claims, personal injury claims, ethical code of conduct, these comes under investigative services. Please understand, the standards don't differentiate in the applicability. That is, the standards are applicable to all these services as mentioned, but then to give clarity in the mind of users, it is bifurcated into 3 parts, and the guidance is a bit customized for each of the service. The third engagement is litigation support. So wheresoever it is explicitly indicated that the professional will be appearing as a witness, his report will be used as an expert's report under section 45 of the Indian Evidence Act, there it comes as litigation support engagement. Okay. So this is the 3 types of services which is covered under 110. Next comes 120, that is fraud risk. Now, once the professional has got the engagement, the next job immediately for the professional is to understand the fraud risk arising in the engagement. So what do we mean by fraud risk? See, not all transactions will have equal degree of risk and they will not be equally important. Different degree and different level of skill set will be required by the professional. It will be required by the professional to cater to each type of service. Now, this bifurcation or this assessment of risk based on the nature of engagement and the complexity of the engagement is done under fraud risk. Based on this risk assessment, the work is prioritized and the professional gives more time and more effort to the factor where the fraud risk is high. Okay. The fraud triangle, as proposed by Dr. Donald Creasy, is taken as a baseline to explain the fraud risk. That is the pressure, opportunity, and rationalization. These are some of the examples of the fraud. That is the fact fraud is usually concealed, makes it very difficult. Now, the next standard is law and regulation. Okay. This standard says that a professional can be appointed either in accordance with some specific law or through a contractual arrangement with the client. Now, what is meant by this? This means that certain act or certain law, they themselves prescribe that a professional can be appointed to do the investigative work. Like the most popular and simple example that we have, that is the Insolvency and Bankruptcy Code, where a transaction auditor can be appointed to check or to verify or to scrutinize certain specific transactions. So that is in accordance with some specified law. Okay, the law itself mandates that a professional can be appointed to do the investigative services. Next, we have, if it is not because of some direct law, then it can be done under the Contract Act. Okay, this can be done under the Contract Act, and all rights and obligations will stem from the Contract Act. Okay, now it is to be kept in mind that if the appointment is under some direct impact law or under some specific law, the rules and regulations and the provisions of that law will be applicable to the professionals. Whereas under the Contract Act, the appointment letter or the engagement letter will only define the scope of the work. The professional cannot go beyond the scope of the work. The law is also clear that principle of natural justice should be given due importance. Let us come to the fourth standard, that is applying hypothesis. A hypothesis is an unproven theory which is formed. It is a question formed for the engagement, and the objective of the entire engagement is to either prove, disprove, or not prove the hypothesis. So to start a forensic engagement, you need to start with some assumption and some presumption. This assumption and presumption is structured and formed in form of hypothesis. And it is constant endeavor of the professional to either prove, disprove, or not prove this hypothesis during the course of the engagement. Let us come to 200 series. So in 200 series, we have, as I said, engagement objective, engagement acceptance, using the work of an expert, engaging with agencies, communication with stakeholders. So the first one, engagement objective. What is the purpose of the engagement? The objective. Please understand, the stronger you define the objective, the stronger you define the objective, the more precise you define the objective, easier and focused it will become to conduct the assignment, to conduct the engagement. So the standard gives 3 types of engagement, and this standard says as to the professional should understand the objective of the engagement. Of course, at the same time, it gives a caveat that the objective shall not be designed to commit to any particular outcome. However, professional is open to draw reasonable conclusion based on the evidence discovered. Okay, so this defines the objective of the engagement. Now, we can see, as I told, these are the annexures where forensic accounting, investigation, and litigation services are given, and the objective of each of them is different. Okay. Let us come to engagement, acceptance, and appointment. Now, here, the concept of engagement letter is clearly introduced here, and a draft engagement letter is also given under this standard. So some sort of preliminary procedures and some due diligence has to be conducted by the professional before he can accept the appointment. So, some due diligence, as in if the professional is being appointed, if I know somebody, I know a professional who was called by someone, and the person was telling that I want you to investigate a particular company, but then basic due diligence is required as to whosoever is appointing to do the engagement, whether he or she has the locus of such appointment or not. So such basic due diligence, such preliminary procedures are required to be done before acceptance of the engagement. A written engagement letter has to be signed between the parties to confirm following this standard, for confirmance of this standard. Now, there's again a problem in case of government agencies where we don't get appointment letter, where we don't get to sign engagement letter. In cases like that, appointment letter will be sufficient and work orders will be sufficient for compliance with such standards. Let us move to using work of an expert. Using work of an expert is in a lot of cases, in a lot of standard, we do need experts to do the job. You may need a legal professional, you may need an engineer, you may need a geologist, you may need multidisciplinary professionals to conduct the work. This standard explains as to how work of each of the professional should be used, what should be the qualification, what should be the criteria, not precisely what should be the qualification, but what should be the criteria for selection of the professional, who's supposed to own the working papers, how do you retrieve the working paper, whose responsibility it is to present it in the report, and all such things are explained in using the work of an expert. Now, engaging with agencies, as I said, a lot of engagement in the forensic accounting and investigation area come out of law enforcement agencies. So these law enforcement agencies, regulatory bodies like SEBI, Reserve Bank of India, IRDA, CBI, ED, these are law enforcement agencies. These agencies, when they appoint, there is a particular way of investigation, there is a particular way of communicating, there is a particular way of presentation. This standard explains how to work with the agencies, how to execute the assignment when the appointment is from the agencies. The next standard, which is the last standard in the 200 series, is communication with the stakeholders. Now, this standard, first of all, classifies the stakeholders. That is, we have two types of stakeholders: the primary stakeholders, which is the appointing authority, and the other stakeholders, which is any other person other than the appointing authority. Again, there are different matters which has to be communicated. Something is called as essential matter, which has to be communicated. It is mandatory. It shall be communicated by the professional. There is something called a significant matter, which may be communicated depending on the complexity and severeness by the professional. Further, communication protocol as to who is to be communicated, how he is to be communicated. Everything is to be governed, is to be decided, and is to be determined by the help of this standard. So as I said, essential matters, significant matters. Okay. This comes the 300, here comes the 300 series. I'll not be spending a lot of time on this because these are the execution standards. So typically these standards give how we do the work. These standards give a prescription as to how the work needs to be done. So planning is engagement and assignment. Each engagement has to be broken into assignment based on the knowledge of the business, based on the risk consideration, based on the technology. Resources is to be allocated based on that. So a threadbare planning of the entire assignment needs to be done. You will notice that the standards have used the word assignments in 300 series because they are applicable to each and every assignment rather than the engagement. Okay. Next, we have evidence and documentation. This standard 320, this standard explains as to how the professional has to discover the evidence and has to maintain the documentation. So reliable and appropriate evidences are to be collected, are to be discussed, and relevant and sufficient documentation is to be maintained. Everything what is collected falls under the definition of document. Whatever has evidentiary value will come under the definition of evidence. This is conducting work procedures. So this standard explains as to how the work procedure is done. Okay, so tools and techniques to be used, the fraud indicators which are developed based on the hypothesis, what methodology needs to be used, the changes in the methodology. This is the meat, this is the crux as to how the work is to be done. And again, we have another standard, review, which is the supervisory function. So this is the review, it is the supervisory function. It supervises as to how the work is done. This supervises as to how the work is done. Okay, between these two standards, we have 340, which is conducting interviews. So conducting interviews are required to be conducted to corroborate the findings. Interview is an art in itself, and interview is conducted so that the facts which we have observed, they do not contradict while the case is presented in a court of law. So the art of interview is explained and guided by standard 340, FIS 340. Review and supervision I've already dealt with. The last standard in 300 series is testifying before a competent authority. Now this standard gives a guidance as to how a professional is supposed to testify before a competent court or a adjudicating authority. The standard says that when a professional testifies, he is witness of the court and he does not belong, or he is not supposed to advocate his client. The professional's job is to present the fact and not to advocate his client. Okay, all these things are given in this standard. So objectivity, independence, neutrality, all these things are given in the standards. We have the 400 series. These are the specialized standards. So in 400 series, Charmi, do we have a lot of questions?
Sir, as of now, not questions.
Okay, good. So I have time.
Yes, sir.
Okay, so this we have 400 series is applying data analysis, evidence discovery in digital domain, and loans and borrowing. So these are specialized set of standards. Under this standard, that is FIS 410, this explains as to how data analysis is to be used in the engagement. So cleaning the data, standardizing the data, performance of step, ensuring integrity, confidentiality, how the data is to be archived, how retrieval is to be done. All this guidance is provided under this standard 410. Okay. Next, we have evidence discovery in digital domain. As we know, e-discovery is a popular term, and e-discovery in itself has become a separate discipline. So this standard deals with as to how the professional has to conduct e-discovery. This also gives flavor of the Information Technology Act and the popular principles, how evidence is discovered, how e-discovery is made. The entire objective of conducting e-discovery is that the case should be sustainable and presentable in a court of law. So all principles, all the laws have to be followed while e-discovery is done. Okay, this standard explains how transactions are retrieved in digital domain and how e-discovery is to be done. Certain key terms like digital domain, digital evidence, e-discovery, they are explained in these standards. Okay. The Next set of standard, the last standard in 400 series is 430. That is loans and borrowing. Now, this standard typically deals with the burning issue that we have, which is diversion and siphoning of fund. This standard tries to explain what is loan, what is borrowing, how we identify that the loan and borrowing is diverted or the loan and borrowing is siphoned. It tries to give a guidance and it tries to explain as to how such transactions are to be investigated. This standard will also help in understanding the PUFE transactions as defined in the Insolvency and Bankruptcy Code. The preferential, undervalued, extortionate, and fraudulent transaction as defined in the Insolvency and Bankruptcy Code can be investigated based on the framework and guidance provided in this standard. Okay. So these are some, these are some examples of some disputes which is given: loan extended or obtained through inappropriate or unethical means, asset offered as securities, funds not utilized as per contractual terms, loans or borrowings that are misutilized, borrower submits falsified documents, so on and so forth. Okay. The next set of standards is 510, that is reporting results. I always say to my team, which we do the investigation, and I always tell to my team that there's no point in doing exceptional work unless you give even a mediocre report. So, there's no point in working hard if you don't even have a mediocre report. Rather, if you have worked for a specific time, but if you augment that with a good report, with excellent findings and with very nice presentation, the client would be valuing that more rather than working more and giving poor report. So the concept of report as to what should be included in the report, what should not be included in the report, whether the professional is to express guilt, whether the professional is to give opinion, whether the professional is to include evidence, whether the professional has to include the expert's view, everything is given in this report. In fact, the standard also, if I'm not wrong, the standard also gives a basic format of the report. Okay, it also gives a basic format of the report as to, yeah, sure, what all things should be included, key elements of the report. The reason is that I am forgetting a lot of contents of the standards is that we are working on the guidance note and there are too many guidance note and too many things to remember. In fact, just before this session, I got an email and we were writing some of the, some of the content, fine tuning some of the contents of the guidance notes as well, because the standards will be mandatory from 1st of July and some fine tuning is required, which we are still doing. We hope that these will be mandatory from 1st of July, as is the opinion of the council during the March notification, which was told. Okay. So this is reporting result. The last standard is quality control. So as it is said that, quality is a journey, it's not an outcome. So continuously improving the quality is part of the standard. This standard has been brought in so that there is an onus on the professional to continuously improving the objective. Whereas the concept of peer review has not been introduced, but the concept of CPE and CPE specific to these subjects, like we have for the ethics and like we have for the audit, CPE specific to this subject will be enforced in due course by the council for all professionals who want to practice in this domain. So this standard has everything to do with the quality control in the forensic engagement. With this, I understand I have completed all the 23 standards. And I was very quick. In fact, I couldn't catch a breath because it's very difficult to cover all 23 standards in a short duration of 1 hour. I understand we have a very niche and limited audience practicing in this domain, and they are very keen on understanding these standards. But according to me, each of these standards should be discussed for an hour to have a thorough and detailed understanding. In fact, the basic principle itself will require a couple of hours to understand all the 10 basic principles. So
Sir,
this was my time, and Charmi, over to you. If we have any questions, we can discuss.
thank you, sir. Sir, we have a question. What are the laws to be covered under forensic accounting or forensic auditing?
Oh, the number of laws are too many for me to say. But please understand that any engagement that you do, it comes out of some predicate offense, and it has to be kept in mind that the basic law which is there in any detective engagement is the IPC, that is the Indian Penal Code, the Evidence Act, and the Information Technology Act. Sections of these act generally, I'm telling generally, not always, generally apply to all sort of engagement. So basically these three acts, one has to have a knowledge of these three acts while one is doing a detection activity. When I say IPC, please don't be paranoid. We only want you to learn and understand few sections of the IPC which are popular. So something like 120B, 405, 409, 4016, 4018, 420, 468, 471, and few more sections. These sections are ones which are regularly used. Similarly, under the Evidence Act, you have certain concepts: relevant, fact in issue, fact, direct evidence, corroborative evidence, primary evidence, secondary evidence, expert opinion. You need to understand all these language and all this terminology if you want to have a detection practice.
Okay, thank you, sir. Second question is laws where evidence is required to be produced in the court of law.
I mean, all forensic, it's a presumption that all forensic engagement will land up in court of law. So I am not able to understand the question. So it's not that there is a particular law by which the report is to be produced in court of law. You have to draft the report presuming that everything will be produced in court of law.
Okay. And sir, one more question. In practical life, when supportings or details are not available from the case, let's say might be only just bank statements or just even not books of accounts are also available. So in such scenario, how practically forensic auditor should work on that? How practically that case need to be handled from your experience?
See, I'll tell you, first of all, in our line of work, we don't have something, one size fits all. We don't have a 42 shirt which can be worn by anybody and everybody. So all solutions are customized. Now, I also have a maxim which I use and which I tell to all the professionals who are diving into this domain as to write whatever you do and do whatever you write. Write whatever you do and do whatever you write. So if you don't have the documents, it is a statement of fact. You're not supposed to opine on something. Please be very clear. Please explain the appointing authority, the primary stakeholder, that we are not having the document and we would not be able to do anything if we don't have the document. If you can make something out of the bank statement, we have seen in many cases where we have had only bank statement and we have done something. If you can do that something, probably give that to the client and close the chapter, because if you have an appointment letter, you are supposed to close it with a report. Otherwise, if you don't have a report, that report may be good, the report may be bad, the report may be complete, the report may be incomplete, but you have to have a report. You cannot use the language that I don't have data, so I cannot issue a report. This cannot be an answer. So there has to be a report. This is only thing which I'll say.
Okay. Thank you, sir. That's it. No more further questions. Let me give formal vote of thanks. On behalf of Continuing Professional Education Committee, I, CA Charmi Doshi, give my hearty vote of thanks to CA Dr. Durgesh Pandey, sir. Sir, your deep dive into this field and the way you explain the topic shows that how you have done deep dive into this field. And considering the topics that what is the overall objective of forensic accounting and investigation standards, overview of forensic accounting and investigation standards in terms of different standards, considering forensic accounting services, investigation services, litigation support services, and so on. Sir, it gives us immense learning out of this session, and looking forward to learn more from you in future. Thank you very much, sir.
Thank you. Thank you so much.
Thank you, sir.
And thank you for the committee for giving me the opportunity. Thank you. Thank you so much.
Thank you. Thank you, everyone.